Hi everyone, I'm Ryan Lehman, iCM's Director of Investments. Thanks for tuning in for our Quick Hits video on our Tactical Income Closed-End Fund Strategy, or TICE, a unique strategy designed to provide an enhanced yield and capitalize on inefficiencies in the closed-end fund market. iCM's TICE strategy is largely based on the same theory that guides our tactical ETF and mutual fund models. That theory being mean reversion, or the idea that over and undervalued assets will return to fair value over time. At its most basic level, mean reversion is really the cornerstone of value investing. This is true not only for asset class valuations, but also for closed-end fund discounts, the anomaly that TICE looks to capitalize on. But before we get to that, let's take a step back and talk about closed-end funds. Closed-end funds are similar to open-end mutual funds and ETFs in that they're broadly diversified and daily liquid. However, they're unique in that their outdated pricing structure can cause their price to trade away from net asset value, the actual dollar amount the fund manages. This allows investors to, at times, buy a dollar's worth of assets for meaningfully less than a dollar, and then subsequently benefit as prices converge on NAV over time. As a proof point, let's take a look at discounts in action. As we can see, discounts exhibit a mean reverting quality, in that they regularly stretch beyond their long-term average, typically during periods of heightened volatility or market stress, but eventually they revert to that average over time. We use the term closed-end fund alpha to describe the excess return potential created by this process. In addition, a welcome byproduct of purchasing closed-end funds at a discount is that it serves to enhance their yield, similar to buying a discount bond. As a fund's discount increases, so does the yield that it provides investors. The yield advantage is clear in practice, with the closed-end fund universe offering a clear yield advantage compared to both the Bloomberg Aggregate Bond Index, which measures investment-grade bonds, as well as the S&P 500 index. Now, circling back to our TICE strategy, TICE is a 40% equity, 60% fixed income portfolio that tactically allocates between closed-end funds and ETFs. And it will own a combination of U.S. and international equities, as well as taxable and municipal bonds. In terms of underlying holdings, the strategy is broadly diversified, holding as many as 98 unique closed-end funds in an ideal environment. And it's really this broad level of diversification that helps to reduce the impact that any single closed-end fund has on performance, leaving just three factors as your primary drivers of risk and return. You have your market return, you have your attractive yield, and then you have closed-end fund alpha. And it's these last two items that help differentiate our TICE strategy, as they're sources of return that aren't necessarily available to your traditional ETF and mutual fund portfolios. So that brings me to the end of our Quick Hits video on iCM's TICE strategy. For a more detailed overview, please reach out to a member of our advisor services team at 888-426-4689 or email us at info@icm-invest.com. Thanks again for your time.